Thank you for joining, everyone. My name is Dr. Rebecca Mears. I'm a member of the VIN Foundation Student Debt Education Team. Really excited to be joining you and SVP for this Climbing Mount Debt session this evening. I know there's a lot going on in the world of student debt and repayment and lots of questions, so seems like a good time for a check-in on what we know now and what we're anticipating. Before we get started here, just a couple of reminders and things. We do try to keep the chat for any technical issues that you have throughout the webinar. Tony may have some questions that he'll ask, and feel free to respond there in the chat as well. If you have questions for us, the Q&A feature down at the bottom of your screen will allow you to ask those questions. It'll also allow you to ask anonymously, as well as upvote questions. So in case you see something similar, that kind of lets us know those are the most pressing questions and to get to those sooner rather than later and live. As far as the recording of the webinar, yes, it will be recorded, and we'll be sending that out in the coming days, as well as some other information. That'll also include the evaluation form for your CE certificate. So keep an eye out for that in the next couple of days, and that will be coming from studentdebt@vinfoundation.org. And with that, I'm going to turn it over to Tony here.
Excellent. Thank you, Becca, and welcome everyone. I know there's probably quite a few questions on student loans given the recent election results. I mean, we've been kind of pouring through what that means, or at least what that might mean for your student loans going forward. But we likely had a whole bunch of changes coming to student loans and repayment options, regardless of what the election outcome was going to be. But now we're, kind of taking that next step and looking at what might happen, given that we're going to have a single party control in DC, and since a lot of these, all of the U.S. student loan repayment options are at the federal level, the folks that are in power and make the rules can change what that landscape looks like. So we'll definitely talk a little bit about what that could look like going forward and how to set yourself up for no matter what is likely to happen, and just kind of scratch the surface in terms of helping you understand where your student loans fit in the grand scheme of all of the other financial things that you should be looking at and working on. So feel free to ask questions along the way. You don't have to wait until I finish. As Becca said, you can use that Q&A feature. That's actually the best way, because then it gives everybody else a chance to upvote things that they also would like to ask or would prefer to ask, and that jumps it up to the top of the list. If you're more comfortable using the chat, you're welcome to put stuff in the chat as well. I've got a second screen here that I'll use to try to keep track of all of that this evening. So this is going to be a little bit of a choose your own adventure. We're going to, walk through some of the basics, what we know now, what might happen in the next, 2 months, 6 months, few years. And then, these other ones are more of a, you tell me, what do you want to focus on? These sessions tend to work best if you're asking questions or contributing your experience with student loan repayment. Beck and I have a lot of experience helping our colleagues navigate their student loans. So chances are, whatever it is that you've been experiencing, somebody else has probably been experiencing as well. And we've likely seen that before. So we might be able to help untangle some of the messes that you all might be dealing with. And there's plenty of that going around for sure. All right, so we're going to dive in. The goals for today, I kind of covered that already in session format, ground rules. Again, feel free to ask questions at any point along the way here. That's the beauty of the Zoom. We don't have to necessarily wait until the end to take questions. We're going to talk a lot tonight about doing a student loan physical exam and some new diagnostics that we're able to look at to help you collect the information that's currently available. And it's nice to know where we stand now, so when things do change going forward, we have a baseline to compare it to, and then we can apply it to whatever the next set of rules or benefits or options are coming down the pike here. Kind of the see one, do one, teach one concept. We're going to show you what this looks like. Hopefully you'll take the opportunity to do this behind the scenes yourself as well, and then you can also pass this knowledge along to your colleagues too, because I know that student loans probably come up when you guys are talking about general things that that you're dealing with. So if we can help our colleagues know where to go and how to make sense of their student loans too, we can reduce at least that one source of stress that many of us are dealing with. We'll definitely cover where we're at now, give you some idea of where we think we're going, right? But that's going to depend upon what exactly happens next, right? So there's a couple of big things that are on the horizon that we have to talk about, and from those outcomes will likely determine what the stage for student loan repayment will look like going forward. And then we'll cover any of those tough topics that overlap with that and try to answer those questions that you have. So here's what some of the submissions that you all included with your registrations. So I peppered some of these throughout the presentation. We'll try to deal with these questions tonight, and then any of the ones that you ask live here along the way. But of course, the big elephant in the room is, what's next, right? So with the election, what do we do? SAVE has already been kind of wrapped up in some turmoil with the courts getting involved and actually putting that plan on hold. And then they also sucked in some of the other income-driven repayment options with it, namely pay as you earn, to that uncertainty in terms of what that's likely to look like going forward. Still, the forgiveness is still on the table, right? So on student loans still have forgiveness. We still have repayment plans that are not wrapped up in all of this uncertainty that still offer forgiveness. So we're going to still talk about forgiveness as a concept and how it works generally, how you make payments based on your income. And then if you hit forgiveness and have to pay a tax on that, how you might ultimately plan for that. And yes, with these repayment plans, you can see your loan balance grow, right? So I did see that there was a pretty good a wide array of those of you that just recently graduated and some of you that have graduated, not so recently, that registered for tonight's session. So obviously the new grads that are staring at repayment now that your grace periods are ending, you may not have a familiarity of what this can look like, but some of these income-driven plans can end up with you paying less than the interest that accrues on your loans, so you can have the loan balance grow over time. Right, so that's actually a feature, not necessarily a bug for the income-driven repayment plans. How do you pick the best repayment plans? Should I consolidate? Right, that's generally for those of you that are new grads. We'll talk about that as well. For those of you that are already in repayment or haven't already consolidated your loans as part of the previous one-time forgiveness count adjustment benefit that was going on for the last couple of years, that ship is likely sailed, the consolidation. So consolidation is really a tool now that we reserve mostly for very recent graduates if they have reason to do so. And we'll talk about what those reasons are. Which program should you use? Well, that's going to depend on which ones are available. Right now, we have a very limited suite of options to choose from, and one of them is actually on hold, which complicates things. And also, the remaining option that you can apply for, income-based repayment, is generally not the plan that you want to be in or start with, right? So not until it's kind of clear that might be the only option remaining. So we'll talk about why all of that is because of the differences with the plans as we go, as we dive a little bit deeper tonight. Okay, so why do I do this? Because I'm a veterinarian with student loans. I'm married to a veterinarian who has even more student loans, and it's just part of something that we deal with. Also, I came from a corporate finance and engineering background before I went to veterinary school. So numbers was something that has always intrigued me. But the student loan repayment system is definitely a different animal altogether. So having a background in finance does not necessarily help you understand your federal student loans because they behave differently than anything you'll ever see in finance. So the more I dove into that, the more complicated it became. But I also find some opportunity in there as well. And that's kind of what we want to talk about tonight and why these plans can be so helpful for veterinarians who have high amounts of student debt, which is a lot of us. So combined, my wife and I have more than $400,000 of federal student loans. We've seen a lot of changes happen to the system over the years. So we've been in repayment for roughly 12 years now. We started out in that standard 10-year plan. Doesn't work very well if you've got a pretty big balance, as some of you are discovering. I'm seeing this more and more from all of our new grads who are like, well, hey, wait a minute. I tried to apply for one of these plans and they're telling me that my first payment is going to be due this February and it's a really big number. Right. And that's unfortunately how these standard plans work, right? So if we, standard plan being the type of repayment plan that you use for almost every other type of debt that you might have, we take our principal, the interest, calculate what the payment needs to be to extinguish that balance in the agreed upon period of time. So a 10-year period with an interest rate of about 6% at $400,000 of principal would require a minimum monthly payment of $4,500 per month, right? And as many of you either already know or are starting to realize, the higher that student loan payment is, the less you have in your budget to work with. And for some of you, that standard 10-year plan payment might even be more than you're taking home after taxes, right? So that may not even be an option for you financially. And that's where the income-driven plans come in and are starting to be a little bit more handy, although they're a little wonky to say the least. Right, so we started out with income-based repayment for the original version that started to become available in 2009. As the name implies, the payments are a function of your income. So it, significantly reduced what our required minimum monthly payment would be. Then we had a new version come online in 2015 called Revised Pay As You Earn. We also had the pandemic forbearance benefits that insert themselves into the whole history of student loan repayment during that, once every 100-year event that we lived through. Turned off student loan repayments, turned off our interest, still gave us forgiveness credit, that progress that we need to reach the finish line here. So that was extremely beneficial. They converted the revised Pay As You Earn plan into what's now called SAVE. The payments were even more beneficial than they were under revised Pay As You Earn or IBR before it. It also had a very helpful unpaid interest benefit, meaning if your minimum monthly payment was less than the interest accrual, the Department of Education actually covered that remaining interest. Unfortunately, that has been called into question. So a handful of states got together and sued the Department of Education, and they found some success. They found a judge in a federal appellate court that said, "Hey, wait a minute, this maybe doesn't meet, the original intention, and we're going to put a pause on this until we can hear arguments on both sides of why we think this should stay or go." And that's currently where we are with SAVE. So that those arguments are being made in front of that federal appellate court. While that plan is in question, anybody that's using it has been put into a general forbearance where no interest is accruing, no payments are due, but you're also not receiving forgiveness credit for that time. You can still apply for SAVE, although you can't really get into it. It's a way to get into this general forbearance, but there's a little bit of a process to get into that forbearance as well. So we've seen that come up with a lot of recent graduates who are trying to get, they would like to get their loans into SAVE. They see that it's an option available to apply for, but then they end up in these variety of forbearances that can be difficult to ultimately end up in that general forbearance where my loans currently reside, my wife's loans currently reside. So the way that we approach this is we make payments based on our income. We're planning as if we're going to hit forgiveness and planning as if we're going to have to pay a tax on what's forgiven. Right, so the way the income-driven plans are structured is you make minimum monthly payments for a maximum amount of time. And if you still have a balance remaining when you hit that maximum, that balance is forgiven. Forgiven debt can be treated as taxable income by the IRS. Right. So for the SAVE plan, for anybody that has graduate school loans, and veterinary school is considered to be graduate school, you get to make payments for no more than 25 years. And if you still have a balance at the end of that 25-year period, whatever is remaining gets forgiven or canceled. and we may have to pay a tax on that, right? So we're about 13 years to go, and we're about 95% of the way to that projected tax target. This is what our forgiveness plan, a snapshot of what our forgiveness plan looks like, right? So we save in it's called a robo-advisor. The one that we use is called Wealthfront. But there's dozens of these out there nowadays. It's just a matter of choosing one if you're comfortable with them. But the dotted line here on this graph represents how much we've contributed. The solid line represents the value of that forgiveness fund. The bigger we can get this difference, right, the amount that we contribute versus the value, the less of our money is actually being used to cover that tax, which reduces the overall amount that we end up paying for our student loans. Right. So if you think about this, at least for a plan like SAVE, 25 years is a long time. Right. So the longer we let this grow, right, the bigger that difference between what we contribute and the value of that asset will be, the lower our cost for our student loans if we have to pay a tax on forgiveness. And this is where we start to then run into challenges, because people generally, again, coming back to that comment that I posted on the beginning of the introduction to this session, I'm working towards forgiveness, but I'm watching my loan balance grow. I owe more than when I graduated. That tends to do some funny things to you mentally. And then I see a lot of our colleagues trying to interject themselves into that process and pay more than the minimum monthly payment, or try to pay off the interest because they can't stand the loan balance growing. When in reality, if you're projected to reach forgiveness, it's better to push as much as you can into that forgiveness bucket and pay the potential tax at the end. Right. And this is where, things start to get a little wobbly, right? So people tend to either not use these plans and choose something else entirely, which is totally fine, right? But you could end up paying more than you otherwise have to towards your student loans, just to avoid this new take on loan repayment. So, and it does bring up, kind of an interesting thought experiment. I mean, I said that we have about $400,000 of student debt. Just to keep the math simple, let's say this is $100,000, the value of this fund. Why don't we just cash in that fund and put that $100,000 towards our student loan balance, reducing it to $300,000? Right? Why is that not a good idea? And feel free to put any thoughts you might have in the chat on why that might not be a good idea, or maybe you can convince me that it is a good idea to do that. It's also helping me take your pulse. Let me know that you're actually there. Nobody has any thoughts on that, huh? Yeah, exactly. So Gabrielle asks, when you say forgiveness fund, are you investing your savings for the tax bomb and then monitoring the growth over time? That's exactly what I'm doing here, right? So this is a dedicated forgiveness fund to cover the quote tax bomb, right? And we're monitoring the growth of that fund over time in anticipation of using that to cover the potential tax on our student loan forgiveness. Right. And this is one of those other, I guess, let's call it a side effect, right? If you're going to use an income driven plan, and if you're reasonably certain that you're going to reach forgiveness, then you should have a dedicated fund to cover that potential tax on student loan forgiveness. Right. It's kind of part of the deal, right? If you're going to take advantage of the benefits of having lower monthly payments based on your income, then you also have to complete the other side of that deal, which could be a tax on forgiveness down the road. So depending on the type of investment you're using, you could end up paying more tax on the funds if you take them out early. I'm not worried too much on the taxes that I'm going to have to pay on this appreciation. Right. I mean, sure, that's a component of it, but I'm not worried too much about the capital gains tax on this fund. Right. The the reason why I don't cash it out, or at least we don't cash it out yet, is because if we made that payment towards our student loans, reducing it from 400 to say 300, with 13 years remaining in student loan repayment, it's still quite likely that we're going to reach forgiveness. Right? We may have lowered our tax, right? But I still have to start this fund all over again. And the tax might be a little bit lower, but I still have to do this again and plan for that potential tax down the road. Right. And I just voluntarily paid $100,000 more towards my student loans than I otherwise had to. Right. So it's better to keep this fund growing over time and watch how our student loan balance is changing and see if we're likely to hit forgiveness, or maybe down the road we don't hit forgiveness, in which case we can redirect that dedicated forgiveness fund to some other activity. Right. And I now, generally speaking, right, just kind of reevaluating the landscape based on what happened in this last election. Right. If for some reason, they do away with SAVE and we have to go back to the older IBR plan, those payments are generally higher. The more we have to pay towards our student loans, the less the forgiveness tax will be, which means we're probably going to have more in this fund than we actually need to cover the tax. But I might be able to draw down this fund to help cover the difference in the monthly payments we have to pay towards our student loans. Which means, again, it's better to be prepared than unprepared, right? It gives us the flexibility to use this forgiveness fund in a couple of different ways, either to pay the tax down the road that we're currently anticipating, or if something changes and we're not going to have nearly as high a tax as we anticipated, or maybe we don't pay a tax at all, then I have some other ways that I could use this dedicated fund to navigate the remainder of student loan repayment. Tyler asks, why is it a question if one will not reach forgiveness? Is there a reason we would not get to forgiveness? Yeah, it really depends. It depends on your income, right? Because the plans are income driven, right? So if you can come up, I mean, if you think about it, if your income is high enough, you can have a payment that might extinguish your balance or a majority of it before you get to forgiveness, which would eliminate entirely the tax or make it very, very low. Right. So you can use an income driven plan and not hit forgiveness. Right. And I think that is and thank you for asking that question, because it kind of brings up a point that I always forget to make clear, is that you can use income driven plans and not hit forgiveness. Right. So if your income is high enough to extinguish the balance, because your income is high enough to generate payments that are high enough that extinguishes the balance before you would hit forgiveness, then there is no tax. Right? I think people tend to think that just because you use an income-driven plan, there's automatically forgiveness and there's automatically some tax. And there's really not anything automatic about that. We've also seen Congress exempt student loan forgiveness from being taxed at the federal level. Right. So anybody that's receiving student loan forgiveness between 2021 and 2025 doesn't have to pay federal income tax on it. Right. Now that's not likely to continue beyond 2025, just given the current makeup of the incoming administration. I mean, maybe we'll be surprised. Who knows? Right. But chances are that particular tax exemption on student loan forgiveness is going to end after 2025. But it could come back. Who knows? It's kind of a now that student loans are this big political football, it really depends on who's going to be in charge of things around the time that you would be reaching forgiveness as to whether or not you may or may not have to pay that income tax. All right, so I mean that's kind of the big picture, right? So now we kind of take a step back and try to figure these things out, right? What's the best repayment option available? How do I know if I'm projected to hit forgiveness? What do my monthly payments look like? How do I add things in like my family size, my marital status, my spouse's income, things like that will all impact whether or not you'll ultimately hit forgiveness. Okay, so federal student loans, there are a multitude of different loan types. So most of them these days, the ones that are out there remaining have direct in the name. If you were in any higher education before July 1st of 2010, then you might have some of these older federal family education loan left. The one-time forgiveness count adjustment, if that sounds familiar, for those of you that have been in repayment for a little while, that was an effort to try to, eliminate these types of loans that were left floating around out there. I don't know that everybody consolidated during that time frame, but a lot of people did. Perkins loans will still pop up every once in a while, but they were discontinued in 2018. Some of you that submitted signalment form homeworks as part of this session, I have some health profession student loans, right? So health profession student loans are a type of federal student loan that are available for veterinarians. Loans for disadvantaged students are also a type of loan that I see infrequently, but are a type of federal student loan. These non-direct loans are kind of those triggers for consolidation, right? So if we're talking about a federal direct consolidation loan, generally speaking, if you have some of these other non-direct loan types, you want to consolidate those into a direct consolidation loan so they can all be covered under something like an income-driven plan and be eligible for forgiveness down the road if you reach it. Private loans are going to be anything that doesn't fall into that category, right? I don't see a lot of private loans from veterinary school, but if you had some private loans from before veterinary school, then you might have some additional loans. Unfortunately, private loans are not factored into any of the federal student loan repayment options, and there's no way for you to get those private loans into the federal student loan system. If you lose track of anything, review your credit report. Right, so this is a great habit to get into. I usually do this once a year, right around tax time, just to make sure that I'm familiar with everything that's on there. Banks are going to use this, when you're applying for a mortgage or financing for a car, or if you're buying into a practice, or even if you're renting an apartment, sometimes they're going to check your credit report. So you should know what's on there before somebody else checks it and says, "Hey, what's this?" We can look for our federal student loan types in the federal student aid database, and that's at studentaid.gov. All right, so I'm going to take you guys over there right now. We'll take a peek. A lot of stuff going on in here lately. There's been a lot of changes. They've been turning this on and off. Right now it's on, so you can log into here. Hopefully it'll let me log in. I haven't actually logged in today. We'll see how this goes. I'll show you what it looks like on the inside if you haven't been in here in a while. Lots of scary language. All right, so it wants me to confirm my contact information. It's always a good thing to do. Make sure your email is up to date in there, and your phone number, your address, especially if you just graduated and it's still got your school address in there. All right, so I'm looking for this dashboard. This gives me a high level overview of my remaining student loan balance. It tells me who my loan servicer is, my next due date. Many of you will see a due date in there of February. It's hard to make any sense of this. Especially a lot of the student loan repayment system is kind of in a on hold state. Mostly this is because I'm in Save. They've been just kind of kicking that down the road a couple of months at a time here. They've settled on February. If I had to guess, mostly because the new administration is going to be in there by then, they're going to be like, "Hey, it's your turn to deal with this." Right? So we'll have to wait and see if that's truly going to be the next due date, or if that's just going to be the time frame that we're next going to get some information on what happens after that. So I don't put a lot of stock into that just yet. So I'm waiting to see what comes out of the court cases, as well as what the new administration intends to do with student loans. But this isn't exactly what I'm looking for in here. I'm actually looking for more details. So I'm going to hit this view details button, and it's going to take me to the next page here. Right, and this is what I'm looking for in this portal, is the download my aid data button. Right, this is going to generate this ugly looking TXT file that has all of your higher education borrowing history in it. And that history is going to be very important in determining which repayment options you're eligible for and ultimately what you might do next. But it also has some other good information in there in terms of what repayment plan you're currently using, if you're currently using one. If it's an income driven plan, it'll tell you when your next income driven repayment recertification date is. So when you use an income driven plan, you have to periodically provide documentation of your income so they know how to calculate the payment. Right, so all of that's going to be in there. Best to work with the data in that TXT file versus the data that's on your loan servicer account. The loan servicers have unfortunately just been horrendous during this entire student loan repayment fiasco. So you can't really trust everything that's on their website, and they all present it in a little bit different way. So that's not terribly helpful either. This is all very consistent. We've got a tool that you can use to upload that information into, and it pulls out the pieces that are relevant and shows it to you in a consistent format as well. Right, and that's what Becca and I use to help you do a student loan physical exam, and I'll show you what that looks like in just a few here. So that's where we're heading next. So VIN Foundation, the Student Debt Center, the My Student Loans tool, right? It's a publicly available resource. Anybody can use it, and everybody does use it. It's configured to make sense of those who have graduate school student loans, particularly veterinarians, right? But anybody that has graduate school student loans could use this tool. The rules are kind of set to what the rules are for those folks that have graduate school student loans. So you're graduated, right? You're in repayment or you're looking at repayment. You've got your student aid data file. I'm going to go grab one that I've got saved for tonight that we'll look at. Right, and this was actually one that one of you submitted that was super helpful in illustrating one of the points, one of the reasons why it was so valuable to consolidate loans immediately after you graduated and apply for SAVE, because this is somebody who graduated in May, consolidated their loans shortly thereafter, and ended their grace period early and got their loans into the SAVE plan before the courts blocked it. That was, I mean, you may not have known it at the time, but that was hugely helpful, right? Because now what Becca and I are seeing from a lot of 2024 graduating veterinarians is that they're approaching the end of their grace period right around now, and they're trying to get their loans into SAVE, and they're running up against all these complicating factors, right? So this was kind of a, you know, for years we've been trying to convince new graduate veterinarians to graduate, consolidate, end your grace period early, and apply for an income-driven plan. And this was a recent graduate who actually took us up on that. And this was an excellent move, right? Because it helped them to get their loans into SAVE, which means they haven't been accruing any interest since this loan was consolidated. Right? The difficult part for those that did not consolidate their loans and end their grace period and get their loans into SAVE before the courts blocked it is that their loans are continuing to accrue interest. They apply for the SAVE plan now. It requires 60 days of a processing forbearance. And once that 60 days expires, then they can be eligible for the general forbearance. The general forbearance is what stops the interest from accruing. Right. So that's kind of the best case scenario for a new grad at this point. If they want to use an income driven plan, or at least stop that interest from accruing while they decide which plan they want to use pending the litigation outcome and pending what changes might come out of the new administration in terms of student loan repayment. All right, so that was one of the things I wanted to illustrate here. We can also see that because they got their loans into SAVE, I mean, this isn't terribly relevant because SAVE is currently blocked and they're in that general forbearance, but we can see that their anniversary date, the date that they would have to next renew their income using a plan like SAVE, provided it survives, would be a year from when they entered repayment, right? So not until next June. We can also see the loan servicer that they have. So Ed Financial is one of the handful of servicers that work with federal student loans. Income-driven repayment options. This is going to become more important pending what the litigation outcome is for SAVE, right? So we know this person is using SAVE. If SAVE goes away, what other options might they be able to use? Right now, pay as you earn is kind of wrapped up in the whole SAVE turmoil, and that has to do historically with how these plans were created. Right, pay as you earn was created in a similar fashion to SAVE, and not only are they questioning some of the provisions in SAVE, but they're questioning whether or not they had the department had the regulatory authority to actually create these plans. Right, so depending on how far the court goes in terms of ruling for or against those plans, we could see kind of a rollback of some of those older plans that were created in a similar fashion as SAVE and pay as you earn were. Now, income-based repayment were created differently. They were created and amended directly into the Higher Education Act, which means they're law. Nobody's challenging those income-driven plans. Those would have to physically be changed by Congress. And that could happen, right? Highly unlikely, right? In most cases, they create new options available to folks who haven't started borrowing yet, because that's a lot cleaner than trying to retrofit, a new option to people who have different loan types that have different contracts that they signed when they took those loans. So, a worst case scenario, this person would still be able to use the new version of IBR, which is very similar to pay as you earn, which is not bad, right? But also has forgiveness spelled out in the law. In this case, after 20 years of payments, if they still have a balance, then they would pay tax on that remaining balance when they reach forgiveness. So that's how you can use the My Student Loans tool to start doing what we call a physical exam, right? We start looking at the loan details in here. We know we had 10 loans, we've got one loan remaining. It's a consolidation loan, which again was a great move on the part of this recent graduate to get their loans into SAVE. They have barely any unpaid interest, right? This was probably the interest that accrued from the time they consolidated to the time they put that plan into put that loan into SAVE. So very minimal. We know that they're eligible for the new version of IBR, which is a pretty strong fallback option in the event we see SAVE and pay as you earn go away pending that court outcome. So that's the physical exam part. If you do have health profession student loans or loans for disadvantaged students, you can add those here, right? So if you had $10,000 of health profession student loans, you could add those into this particular summary, and it will account for those separately, right? And this is mostly if you're kind of a recent grad who has not yet consolidated your loans, but you want to see what your portfolio would look like and the weighted average interest rate, what that would look like if you added in those non-direct loan types that you might have. Right, so that can help you to keep track of those loans within the My Student Loans tool. All right. Yeah. Okay. So some good questions there coming in. So, all right. So SAVE is blocked. Give me 1 second, and I'll dive into some of those more specific questions there. But save is blocked, and that started in July, July 22nd, I think it was. No interest, no payments for at least another 6 months, or at least that's what the Department of Education is saying. But you don't get any forgiveness credit either, at least in it was officially blocked, which was that late July date. You don't have to provide any income recertification for anybody who got into save before the court blocked it. Forgiveness under any of the other plans that were created in a similar manner that SAVE was created. So that's ICR, which was created in 1994, Pay As You Earn in 2012, revised Pay As You Earn in 2015, which became SAVE in 2023. Right, all of those plans are the ones that are wrapped up in the current litigation around SAVE. Forgiveness is not impacted by for either of the income-based repayment plans, so IBR 2009 or IBR 2014. So in the example that I showed, this person is eligible for the new version of IBR, which I call IBR 2014. It's an either or thing. Right? So IBR 2014, if the first loan you received was after July 1st of 2024, then that makes you eligible for the new version of IBR 2014. If not, then you're stuck with the older one, which is my case, right? My case or my wife's case, right? We're not eligible for the new version of IBR. The new version of IBR is more beneficial than the old one. The payments are lower, the time to forgiveness is lower. The applications for the plans, although they're resuming soon, you can use the studentaid.gov portal to provide applications. They've been really slow in processing them. So they said they're going to resume them, quote, soon. I don't, maybe that's happened. It's kind of hard to tell. They're still working on a backlog, right? So when the court stopped SAVE, it kind of stopped the whole system. So it put a lot of that on hold for several months. And, it was a terrible timing because of all the new graduates too. And a lot of them were applying or consolidating. So it's going to take a while to get through a lot of those backlog of applications. But you can still apply. You can still use the electronic area to apply, but you're going to have to follow those applications very closely because it's kind of a mess. I would take lots of screenshots, even print out what you submitted to them so you can confirm with them later. There's been a lot of reports of the loan servicers looking at applications that are either missing data that people are quite certain that they submitted when they applied, but it's just not showing up on the other end. And that's having some issues in terms of which repayment plan that you ultimately end up in. And then they might reopen Pay As You Earn. So as part of the creation of SAVE, they phased out Pay As You Earn and ICR. Anybody that was using those plans when that phased out went into effect, which was July of 2024, you can keep using it. Right, but Pay As You Earn was a really beneficial plan. ICR was really beneficial for folks that were really close to forgiveness, but taking them away has really limited a lot of the options that people have, particularly with SAVE coming into question. So they're going to reopen Pay As You Earn and ICR. They said this fall. I mean, we're already in this fall, and this administration is on its way out the door, right? So they're going to have to do that soon if they want people to be able to use those again. But if we do see those plans reopen again, for some people, it might provide another option, again, pending what the courts decide to do with SAVE and how far they choose to go if they were to eliminate those plans that were created in the same way that SAVE was created. So what's next? And then kind of the question here that both Clint and Tyler are asking in there, should you switch out of SAVE? I think it's too soon. Again, and one of the reasons why you don't want to be an IBR too soon is IBR, again, was created separate legislation, has its own space in the Code of Federal Regulations, and it has its own specific provisions. The problem with IBR is that if something better is available, when you leave IBR, the law requires that any unpaid interest you have gets capitalized, which means it gets added to your principal. The higher your principal, the more interest you accrue, the more you're going to pay whether you reach forgiveness or not. Right? So that's why I'm really reluctant to have people run into IBR, even the new version of IBR, because if it turns out that save some version of it or repay or pay survive, if you switch to one of those plans from IBR, you're going to increase your principal, right? And it's just not clear yet what's going to happen. So there's really no reason to take on that additional risk just yet. Now, it could be that IBR is going to be your best remaining option going forward. And when that looks like it's going to be the case, then that's when you would move your loans into that repayment plan. But right now it's too soon to do that. That risk is a little bit too high, pending what comes out of those court cases. Oh, yeah. So, okay, anniversary dates. Let's look at the anniversary dates. Normally, 1 year from the time that you entered that plan is when your income information is due. This has been an issue since the pandemic forbearance benefits ended. Restarting repayment has been problematic. Layer on all of the changes and now the court involvement, and we have even more issues with renewing income or income-driven plans. So they keep pushing these anniversary dates into the future. The current guidance is that if your anniversary date is before February 2025, right? So if you open up you upload your student aid data file into the My Student Loans tool, and you open up the details here for any of these 3 tabs, and you look at the anniversary date for your plan, if you see a date in there that's before February of 2025, then you can add 1 year to it. Right. So if you have an anniversary date that's December of 2024 or January of 2025, add 1 year to it. That's when you're next going to be required to renew your income information. If you're in SAVE, you don't have to provide any recertification because your loans are technically in that general forbearance. If you remember signing up when you applied for an income-driven plan, if you remember a bunch of documentation about the Department of Education pulling your income automatically from the IRS data retrieval tool system, that's probably not going to be ready anytime soon. So you may have to link your tax return manually, either by uploading that or clicking the buttons that send that data retrieval tool out to get your most recent AGI from a tax return, if and when you do have to provide that next set of income information. Oh, we forgot about the count adjustment. Okay, so there was a one-time forgiveness payment account adjustment that was available for more than 2 years, from 2022 to 2024. And what this benefit was an opportunity to go back in time and try to give people forgiveness credit for what was perceived to be loan servicer incompetence, essentially. Right? So the incentives in the system over time were such that it was easier and more lucrative for the loan servicers to put your loans into deferments and forbearance than it was to talk to you about income-driven repayment plans. So the Biden administration said, all right, well, we're going to kind of hit the reset button here. Anybody that has federal student loans that have been in any kind of repayment status after 1994 is going to automatically receive forgiveness credit for those time periods. The only catch was that your loans had to be, quote, federally held, which means they needed to be a direct loan, right, or a federally held FFEL program loan. And that was why there was the incentive for people to consolidate those FFEL program loans and even older loans with some newer loans to get into a direct consolidation loan, because it wouldn't reset your forgiveness credit. It would actually go back in time and pull the loan that was included in there that had the longest duration of repayment and give you a forgiveness count equal to that loan that was in repayment the longest. Right. So we did see millions of people receive student loan forgiveness using this look back of repayment time, regardless of the repayment plan you used, as long as you consolidated or put your loans in a position to receive this credit before June 30th of 2024. Right. And for those that didn't reach forgiveness, a payment count adjustment is going to be made available so you can see what your progress is towards forgiveness. Right, so they first went through and eliminated the loan balances for those who had eclipsed the required amount of time to be granted forgiveness. And the rest of us that still have some time to go will get the count so we can see where we are. Right, and it's not readily available yet. Like you can't look it up in studentaid.gov. You can't find it in your student aid file just yet, but there is a hacky way for you to be able to see it. Right. So if you log into studentaid.gov, well, let's see if I'm still logged in here. No, I'm gonna have to log in again. So I'm gonna log into studentaid.gov. Gonna make me do this and log you out pretty fast. And this is something I would encourage you guys to do too, particularly if you've had your loans in repayment for a little while. Log in and then open a new browser tab. Right next to that one. Oops, let me come back here. Right, and then you open up and enter this web address in it. It's a link to an API. It's probably what they're going to use to populate your account adjustment data in your account, or they'll let the loan servicers use this. But if you go to studentaid.gov app, here, actually, I'll copy this and paste it into the chat. But you're going to see something that looks horribly ugly like this. Right, and in here is your qualifying payment count. Right, so I've got consolidation loans remaining. I've got a unsubsidized component and a subsidized component. They're pretty much the same loan, but they keep those two components separate. Each one of those remaining loans has a qualifying payment of 143, which is just shy of 12 years, which is what I told you originally. That makes sense. I've been in repayment for a little more than 12 years, or just about 12 years. I've got 13 years to go before I reach forgiveness. And that's what this says, forgiveness remaining payments. Right, so this is how you can check your count. Right, it's kind of clunky, it's kind of ugly, but it does allow you to get a window into what the Department of Education has on a file for your forgiveness count adjustment. It's not, I don't believe it's quite finalized yet. We have seen some counts from people who have recently consolidated their loans even before that deadline, but the count still looks a little off. So I think they're still working through that, and that's probably why it hasn't been finalized and made available just yet. Okay. So I did miss a question here from Tyler. So would you still recommend applying for the SAVE program to the new grads at this point? Yes, I would. Right. Again, coming back to, I really don't think it makes sense for you to put your loans into IBR just yet because of that risk of that capitalization penalty if it turns out that you're going to move away from that plan pending these court cases. So you can apply for SAVE. Right. Unfortunately, that's going to, if you're applying for SAVE now, that's going to trigger a processing forbearance, which is going to take 60 days. Can't happen any faster. And then you'll probably have to call back and request the general forbearance after that 60-day period. And that processing forbearance cannot start until your grace period ends. Now, if you graduated in May, you're already past your grace period, right? Which means you're starting to receive some statements that say what your payments are going to be if you don't choose something else, or your grace period is really close to ending. Right, so it'll take you a little bit of time, right? But you'll get, if you apply for SAVE now, you'll start that processing forbearance, which is 60 days, and then you'll be eligible for that general forbearance, which is what those of us that are in SAVE are currently receiving. right? So no interest accrues, no forgiveness credit, but no payments are due either. Right? That processing forbearance, the interest will accrue during that time frame, unfortunately.
I
Already
also
done
want to
that.
make sure that we get Drew's question in the Q&A here.
Oh,
If I
great.
can,
Thank you.
if I consolidated my loans in hopes to qualify for SAVE and then SAVE was blocked before I was approved, is that bad? In addition, since I consolidated and did not get SAVE and interest has been accruing even though I am in forbearance, will that amount accumulated be credited back?
All right. So if you consolidated your loans and you applied for SAVE during that consolidation, chances are your consolidation has probably been processed, right? So those are two separate events, right? So, and that's another good reason to do your student loan physical exam, right? Grab your student aid data file, upload it into the VIN Foundation My Student Loans tool, and see what's remaining, right? If your loans are consolidated, you'll see consolidated loan balances remaining, right? So if your loans are not consolidated, right? So if I look at what this recent graduate's loans look like before the consolidation, then you'll see a bunch of principal balances for these initial loans, these original loans, right? So if your consolidation has been processed, then you'll see the consolidation loan in your loan types, and you'll see principal for it, right? And then you can check to see what repayment plan is listed there. Chances are, if you didn't get your loans into the SAVE plan before the courts blocked it, what's been happening for those folks that have consolidated is their loans end up in what's called a standard consolidation plan. Right? And the standard consolidation plan for nearly every new graduate veterinarian is a 30-year fixed plan. So like a mortgage, it's essentially it's a mortgage type payment plan. So if that's what happened to you, right, you'll see it'll say standard here, it'll say standard 30, then you'll want to apply for that SAVE general forbearance. And this is where it'll become important what documentation they have for you on the other end, right? If your loan servicer has a copy of your income driven application that you submitted with your consolidation and it shows SAVE on there, well, maybe then they can say, all right, well, you've already exhausted the processing forbearance. We can get you into the general forbearance as of 60 days after that processing forbearance. That would be the best case scenario, right? But that's going to require them to have that application on their end that shows that you applied for SAVE. And that's where we've seen some real funky stuff happening when people applied for SAVE as part of their consolidations. What ended up on the other end in the loan servicer hands was a application that didn't have a repayment plan selected. And then they're taking all of those loans and essentially putting them in that standard consolidation plan, which means you have to then start that application process for SAVE to get into that general forbearance from you're starting that process over essentially. Right? So you'll be in that processing forbearance for 60 days and then eventually in the general forbearance where the interest will stop accruing. And this has just been one of the kind of those unfortunate again, the student debt system has just been a fiasco since the pandemic forbearance benefits, essentially. So very beneficial in some points, not very beneficial at other points. And unfortunately, with the timing of the court blockage here, particularly for new grads, that has caught a lot of the 2024 grad class in kind of this limbo of, getting their loans into a beneficial status has taken longer, which means you've accrued more interest than you otherwise should have. Yeah, and will they credit that accumulated interest back? Ooh, highly unlikely, right? Again, if you can prove that you have that SAVE plan selected, then you might get lucky that at 60 days after your consolidation process, they'll put you in that general forbearance and maybe they'll eliminate any interest that accrued after that. All right, so and this kind of there's a good lead in into, well, how should I approach repayment in general, right? Let's say, there's just too much uncertainty for me to consider in these income-driven plans. What does that leave me otherwise? And that is where the time-driven plans come into play. And these are more traditional repayment options, right? So the standard plans, the standard 10-year plan, if you consolidated and your balance is more than $35,000, then you are eligible for the 30-year plan, or they're automatically put into that 30-year plan, right? So these are plans that take your principal, interest, and the amount of time to hit a zero balance, and then that's how they calculate the payment, right? The problem with the standard plans are, depending on where your balance is, right, your minimum monthly payments can be really, really high, right? And that's, this is where the amount matters, right? For the income-driven plans, the amounts don't matter as much because the payments are a function of your income, right? But when it comes to how else can I get rid of my student loans, the amounts matter, right? And so your budget's going to have to be able to take a payment like this, right? And we generally don't want to see you sacrificing critical areas of your financial wellness just to eliminate your student loans faster, right? Because you do have other options. Unfortunately, now they're, wrapped up in a bit of a cloud of uncertainty, but there are still going to be ones there for you. So if you can, take a deep breath, consider what those options are, look at what it could cost you to pay your balance to zero faster, and compare that against what an income-driven plan will offer you, even in kind of a worst case scenario if you have to go back to IBR, and see what that difference is, right? But you do have time to process all of this, right? You may have some homework to try to get your loans into that general forbearance so you can get the interest to stop accruing while you work through which repayment strategy is going to be best for you, right? But you do have some time, right? Until we get a court ruling, until we see what's next on the horizon from this incoming administration, and then also what this outgoing administration is able to get done before they leave, right? So there's quite a bit left to happen here before you ultimately have to decide. The goal is to put yourself in a position to be ready for a multitude of outcomes, right? So maybe there's an opportunity to get back into pay as you earn if it survives, right? Maybe there's the window to stick with save if it survives in some manner, right? Maybe you're going to jump into the new version of IBR because it's your last best option available, right? Maybe you're going to decide that you've got the budget to navigate a time-driven repayment option, right? But you don't have to decide that right now, right? But the best you can do is get your loans into that general forbearance so the interest stops accruing in the meantime. All right, so alternative repayment options, these are variations on time-driven options. So this is I want to pay my loans back as fast as possible. How do you do that? Generally speaking, it works best if you're paying the highest interest rate loans first. However, right, just know that, these types of things work best for, more traditional kinds of debt, credit card debt, other less flexible, personal loans, car loans, those sorts of things, right? Your federal student loans are the most flexible but annoying debt you're ever going to have, right? So I generally don't see a lot of, you could certainly accomplish these things, right? It's not impossible to do these things with your student loans. However, it's just not a great use of your resources, right? Because inevitably what happens is you have to sacrifice other areas of your overall financial wellness just to make this happen, which is inevitably costing you money, right? If you're foregoing your retirement account, if you don't have a robust emergency fund, or you're postponing buying a home when you otherwise could, right? Those are things that are going to cost you in the long run. So not only are you paying more than you have to towards your student loans in many cases, you're also missing out on those other opportunities to grow your overall financial wealth and wellness, right? So that's generally why I don't recommend those alternative types of repayment options because they just aren't necessary for your student loans. I totally get it. I mean, I'd rather be done with student loan repayment than have to manage it longer. But the flexibility it provides is extremely beneficial if you use it in a beneficial way for the rest of your overall financial wellness. So how do they calculate the payments? Right, generally speaking, right, it's kind of hard because right now they're really not calculating anything, right? But your taxable income minus some percentage multiplied by the federal poverty guidelines, right? So for pay as you earn, for revised pay as you earn, for the new version of IBR, they take 150% of the federal poverty guidelines, and you're allowed to subtract that off of your taxable income. For SAVE, it was 225%, right? That's why SAVE was so helpful. The new versions of IBR, depending on which one you're eligible for, the payment will either be 10% of that discretionary income or 15% of that discretionary income calculation. Even some of the newer plans that are floating around out there, if you dig around on the internet and you look at what would Republicans like to see happen to federal student loans, they still put on the table some kind of income-driven option. And the one that they put on the table most recently in a House resolution earlier this year had this 150% discretionary income calculation. So 10% was the payment, and the discretionary income formula used 150% of the federal poverty guidelines. So very similar to pay as you earn and the new version of IBR, right? So if we do see something like that, maybe that will be a program that's more beneficial for you as well, which is another reason why you might hold off on jumping into IBR, because again, no matter what the Republicans do there, unless they also concurrently eliminate the capitalization provision, which they may do, IBR would still capitalize the unpaid interest on your loans if you switch to whatever that new plan is down the road. Again, wild speculation, presuming that that's what actually happens. But that's a reason why you might hold off on starting with IBR, just because, again, it's too soon to say that makes sense to do. This is just an idea of what the payments are using income-driven plans based on various income levels, right? So again, this is why the income-driven plans are so helpful for veterinarians, right? When we see those incomes kind of in that 130, 150 range, they're barely in that $1,000 a month, regardless of what your student loan balance is, right? That's why they're so helpful. You make payments until you reach the maximum required time frame. So it's either 20 years for a plan like the new version of IBR, or pay as you earn, it survives. Save or repay, or 25 years. The old version of IBR is 25 years. And so if you make payments until you reach that threshold, if you still have a balance remaining, that's what triggers the forgiveness, right? If you don't have a balance remaining, or you eliminate that balance before that 20 or 25-year period, then there is nothing left to forgive. There's no tax, right? You only hit the tax if you reach the maximum repayment period and you have a balance remaining. We do have this current tax exemption, right? So the people who have received student loan forgiveness this year, the past year, next year, right, will not have to pay any federal income tax on it. I'm going to skip public service loan forgiveness because it doesn't really apply to anybody working for SVP, but just know that that is an option that's available to you if you end up working for a nonprofit organization. And that's an opportunity to hit forgiveness sooner. It's a 10-year time frame, and public service loan forgiveness specifically exempts any taxes at the federal level on forgiveness. All right. Okay, so where would you like to go next? Any financial wellness? All right, great. Thank you, Gabrielle. All right, so regardless of how you choose to pay your student loans, whether you're going to work towards forgiveness or you're going to accelerate your payoff, or you're going to use a time-driven plan and have a zero balance in a known amount of time. These are things that you should be doing regardless of what you're doing with your student loans. Right? So have a robust emergency fund. Right? Try to get to 6 months of your average calculated expenses. Right? And that means you need to have a budget. Right? So unfortunately, over the time that I've been collecting data from veterinarians on student loan repayment, most veterinarians fall on the no side of do you budget, right? And that, it's just risky, right? Sure, you can try to keep track of everything in your head, or you can periodically check in on your bank statements, but you can't manage what you don't measure, right? We know this as clinicians. It also applies to finances. If you don't know your ins and outs, your financial ins and outs, you cannot manage them effectively, right? So in order for you to build a robust emergency fund, in order for you to know how much to contribute towards your retirement account, you have to have a budget, right? So you have to know what those average expenses are. So start with a spreadsheet if you need to, right? There are hundreds of budgeting platforms out there. I don't use any of them. I use spreadsheets because I find spreadsheets, I'm just comfortable with them, and they're also the most customizable out there. But if a budgeting app helps you to do the budgeting on a regular basis, then use it, right? Find one that matches your style and makes you go in there periodically to enter your income and expenses and check some reports that it has available for you. Pick the one that works the best for you. It may take some trial and error, but stick with it, right? Because the more you manage, or the more that you measure, that the easier it is to manage what's coming in and what's going out. Don't leave any retirement savings money on the table, right? So target at least 10 to 15% of your gross income into tax advantaged retirement accounts. And those are 401ks, traditional IRAs, Roth IRAs, maybe you even have a Roth component in your 401k, right? These are tax deferred growth opportunities, right? So it reduces the amount that you pay on taxes. Those amounts grow tax free, and depending on what type of account they're in, right, you may be able to withdraw them tax free down the road, right? So this is what's going to help you build your overall financial wealth and wellness, right? So make sure that's a critical component before you start, paying more than you have to towards your student loan. If you have other types of debt, credit card debt, private loans, any other personal loan, auto loan, all of those are less flexible than your student loans, right? Even though the student loan number is probably bigger, right? Hopefully, right? These are more risky, right? So if you're going to accelerate any debt payoff, accelerate these first, right? Even if your student loan has a higher interest rate than maybe some personal loan or an auto loan, right? Those are still more risky than your student loan. Right? So if you're going to pay off something first, pay off the less flexible debt before you pay anything more than you have to towards your student loans. And use this as an opportunity, right? Again, we've got this, rare opportunity here where student loan repayment, at least for those that are in SAVE or in that general forbearance, no payments are due, no interest is accruing, right? It's not, your student loans are not costing you anything in that scenario. Use that as an opportunity to really boost these other areas of your overall financial wellness. Right? If you have plans to start and expand the family, it's expensive, right? So make sure you've got some funds earmarked, boost that emergency fund. If you're using an income-driven plan and you're convinced that you're going to hit forgiveness, then make sure that you're saving for that potential tax down the road. Right. So those are areas that you want to work into your budget, so you don't have to worry so much about your student loans. And over time, you'll see some of these things grow well beyond your student loans, and your student loans become a lesser and lesser component of your overall net worth and your overall financial wellness, right? So it can be pretty powerful to take control of these other areas instead of worrying about what your student loans are doing or not doing, right? So my student loans, I mean, while I know what's going on with them, I really don't worry too much about what's going to happen with them long term. If it takes the full 25 years to see them eliminated, if it takes another 10 years beyond that because there's maybe a better option going forward, I really don't care, right? Because the longer those stretch out, as long as the payment is reasonable, I have the opportunity to grow those other areas of my overall financial wellness while managing those student loans to whatever that finish line looks like. And I do think people get way hung up on, trying to eliminate their student loans faster in many cases than their income will allow, and they don't account for what they're giving up to do that. And those, again, 401k contributions, in most cases, in these tax advantage retirement accounts, your employer is probably offering some kind of matching incentive, right? If you're foregoing that or you're not contributing enough to receive that maximum matching contribution, then you're leaving money on the table, right? So make sure that you maximize those contributions first before you start embarking on some other type of aggressive student loan repayment strategy. And just by example, I was trying to think of how I'm always trying to think of how to put this into context for you guys. But and I know that many of you don't have financial backgrounds, and retirement savings and all those things are very new to you. But when you look at your student loans, right? So if I go back to this example that we're using, right, and I start looking at the interest rates that were in for a lot of these loans, right? So undergrad loans have very low interest rates. Depending on when you were in vet school, you might even have some in the 4 and 5% range. And then by the time you finished, they were in the 7-8% range, right? So they changed quite a bit, but they're in a pretty narrow band, right? But none of them are double digits, right? They're all pretty reasonable and in fact, relatively lower than you could probably get on most mortgages these days, right? So if we look at the average return for the S&P 500, which is a collection of 500 stocks in the US stock market, since I graduated in 2012, since I graduated from veterinary school, it has averaged a 14% return per year. Does it make sense for you to forego investing at 14% return to pay extra on a loan that might have an interest rate of 4, 5, or 6%? The answer is no, right? So it's one of those things that falls into the financial no-brainer category, right? So you want to boost these things, and if you look at this, if you remember from what I showed you from my forgiveness plan, it kind of mirrors this exactly, right? So this is the big dip from COVID when we shut down the economy, and this is when it took off after. Right now, it's impossible to predict all these ups and downs, but if you're not in here, you're going to miss all of the ups, right? So that's why it's better to just start early, contribute often, and make it a core area of your financial planning. Also, the way that we calculate payments for student loans factors in these sorts of things. Right. So if you look at your tax return, and I encourage you all to do this when you file your taxes for 2024, when you are contributing to things like 401ks or health savings accounts, right, or traditional IRAs, that reduces your gross income down to your adjusted gross income. They use your adjusted gross income when they calculate your monthly student loan payment. Right. So if you contribute $20,000 to your 401k on a pre-tax basis, right, you can reduce your taxes by about $5,000 and your student loan payment by about $2,000 when those student loan payments are on. Right. So there's a lot of concurrent savings there and incentives that a lot of people miss out on because they don't understand how all of these things interact with each other. When you go to buy a home, right, try to save to have at least a 20% down payment for a conventional loan, right? That reduces any of those other extra payments that you have to make that cover things like mortgage insurance if you have less than 20% equity in that particular loan. So having cash available and a lower monthly payment will make you look like a less risky investment to a bank who's offering you a loan. Right? So you can actually improve your lending circumstances and ability to get a home or a practice loan by using an income-driven repayment plan. Right? If you're using a traditional repayment plan and your monthly payment is, 25, 35, 45, or more than 50% of your gross income, it's going to be harder for you to get a loan. Right? The banks aren't going to give you anything but maybe a pat on the back that you're trying to pay extra towards your student loans when you go to get a home loan. But if you're, half of your income's going towards your student loan payment, you're one oops away from not being able to make not only your student loan payment, but definitely not a mortgage payment. Right? So, that doesn't look very good to them. Right? But if your credit report shows a low monthly payment on your student loans because you're using your income as a guide and you're building a home down payment fund and show some other ability to invest and build some overall wealth, then you're going to look like a better borrowing candidate to the bank. Yeah, do you have any insights on physicians loans for DVM trying to buy a first home? Yeah, you can use those and that's fine. I would still personally prefer to go for the 20% down, right? What the physicians loans and those types of things do is allow you to put down less towards that home, right? And, depending on the market that you're buying in, putting less down makes it a little bit more risky just because you have the potential of being underwater on that home because you don't have any equity in it, right? If you've got, 20% down, the market has to take that local market has to take a pretty big dive for you to be underwater on your house, right? So now the physician loans and some of those other incentives to help first-time home buyers get a loan with less down can be helpful, right? But they're still not without risk, right? So I personally still would prefer to have a more robust down payment when possible. Right now, timing might be such that if you can pull together the physician's loan and you found the perfect house that you want to move on right away and you can make that happen that way, great, right? But you want to try to build up that equity in that home sooner rather than later, so you're less subject to that potential to be underwater on your home if there's a downturn in that real estate market for any reason, right? So just be careful, right? I mean, those things can be useful tools, right? But they're still not without risk. The same thing applies to when and if you have a practice opportunity show up for you, right? So maybe you're going to have an opportunity to buy into a practice later on, or you want to start your own, right? But you're going to have cash to be able to do that, right? So if you're putting a lot of your funds towards paying off your student loans, right, that's going to make it less likely that you'll be ready for those opportunities when they present themselves. So you don't have to have your student loans paid in full to buy in or start a practice, right? So you can do those things while still having a student loan balance. And then forgiveness planning, start with a savings account, but once you look at that savings account and you determine that, I could probably do better than 4% on that savings account, right? That's when you're ready to take that next step, right? And we started our forgiveness savings fund with Wealthfront, but there are a number of those that fall into that same robo-advisor category. If you're not comfortable doing any or all of this on your own, then you could certainly seek out the help of a certified financial planner. Look for that CFP designation. If they're not a CFP, ask them if they're a fiduciary. Right? So fiduciary means that they're bound to a standard where they are going to make recommendations that are in your best interest and not necessarily recommendations that are going to help increase their bottom line, right? And that may sound like common sense, but unfortunately, the financial planning industry is a bit of a Wild West. And a lot of them make money on commission-based products, which means they may sell you something that has a really high commission that's going to be great for them, but it may not necessarily be great for you. And so if they're a fiduciary, that reduces that possibility that they're operating on some kind of commission-based product. Right. So ask, anybody that you meet with, just ask them if they're a fiduciary. These are some resources that you can use to filter through that. And generally that CFP designation means that they adhere to that fiduciary standard. And I believe this National Association of Personal and Financial Advisors, I think there's a fiduciary filter on that search tool, but that actually helps to narrow down and find those folks that might be in your area. That forgiveness also serves as an asset. And like I demonstrated earlier, now I'm kind of in the back of my head thinking, well, if SAVE goes away and we just have the old version of IBR, so be it. It's not terrible. It's less than ideal, right? But the payments will be higher, which means it'll reduce the amount that hits forgiveness. The tax will be lower. Maybe we'll use some of that forgiveness savings fund to help cover the differences in those monthly student loan payments, right? So it doesn't interrupt our overall budget and the things that we're doing outside of our student loans to build our overall wealth and wellness, right? So we can kind of pull different levers no matter where the student loan system goes, because we started this dedicated forgiveness fund sooner rather than later. Right. And these are some of the things that we're starting to see because these forgiveness options have been around long enough. People have been using them, but haven't really gotten around to saving for that potential tax down the road. And, that's getting a little dicey, right? When you are 10 years into your career and you're looking at a forgiveness now, maybe 10 or 15 years down the road, and you haven't started saving yet, that can get pretty tough, right? That's going to become a bigger chunk of your budget to have to try to reach that target, right? So the sooner you can start saving for that, the better, right? That'll leave you in a position to be able to adjust more readily, no matter what happens with student loans down the road. If you can afford to pay more, I generally wouldn't. I can almost always find something better, somewhere else better to put extra funds to increase the overall return to build our wealth higher than just making an extra payment towards our student loan. Right. But if you are convinced that that's got to happen for you, then, just do it smartly. Right. So, do it in a way where you're targeting the higher interest rate loans first, making sure you're already set up comfortably financially to weather any unforeseen circumstances, taking advantage of those tax advantage savings opportunities that we mentioned. And then if you still have the funds above and beyond that to pay off your student loans more aggressively, then go for it. Right. But, there's generally always somewhere else that I can find to put some extra funds that are going to increase the overall return compared to the benefit it will have paying extra towards the student loans. All right, where else would you like to go? Payment mistakes. All right. Cool. Avoid these common mishaps. So assuming an income-driven plan won't work, right? Yes, we've seen a lot of bumps in the road, particularly recently, but we've also seen some extreme benefits offered to federal student loan borrowers, right? These periods where your payments are turned off and there's no interest accruing, or even when we had access to save and whatever our payments were below our interest was still being covered by the Department of Education. Those are enormous opportunities, right? You're never going to get that kind of flexibility with any other debt that you're ever going to have, right? So, again, this is why I'm not terribly concerned with what comes next, at least until we see it. but I believe that some version of income-driven repayment is here to stay for the long haul, right? What exactly that's going to look like until we get to the end of repayment, I can't say for sure, but I do have a pretty good idea of what that probably looks like. So I'm going to stick with it until I have reason not to, or something better that can be done. That consolidation procrastination, you know, unfortunately, so for those of you that are new grads, you know, if you're kind of sitting there at the end of your grace period, you know, that you kind of miss the consolidation window, right? So consolidation is best if you do it very close to graduation, like we saw in the example that I showed, right? Now, unless you have some other loan types that can benefit from being included in a direct consolidation loan, that's a different story, right? But if you're sitting on all direct loans from vet school and you're at the end of your grace period, there's not a benefit for you to consolidate. To the extent that you have access to fourth year students, you may want to pass that information along to them so they do not make that same mistake when they are faced with repayment next year. Starting with that income-based repayment, so this is one of the questions that you guys asked previously. You know, I would avoid IBR until absolutely necessary, and we're not there yet, right? So I wouldn't start with IBR, right? Because there are those consequences of moving away from it, if it ends up that you have to, or would benefit from doing so. Forbearance, deferments, missing renewals. So certain forbearances, like the SAVE general forbearance that we're in, that's okay, right? But putting your loans into a deferment, particularly if you pursue some additional schooling down the road, or because, you know, maybe you're moving or changing jobs or something like that, is contraindicated, right? If you have an interruption in your income for any reason, right? Maybe you go on leave or something, like you have a child and you take some family leave, use an income driven plan, have the payment calculated based on your lower income instead of putting your loans in a deferment, right? Deferment can be one of those things that also triggers capitalization, right? So if you put your loans into deferment, there's no payments due, the interest continues to accrue. You either have to pay all of that interest when those loans come out of that deferment, or it gets capitalized, added to your principal, right? The higher your principal, the more interest you accrue, the more you pay over time. So avoid the deferment, use the income driven plans, and you can have the payment calculated lower if you have a period of lower income for any reason. When you do use an income driven plan, you have to provide updated income information at least once a year. If your income decreases at any point before that yearly renewal is due, you can submit to have the payment recalculated. You don't have to wait until that year time frame is up, right? But this also leads people to miss those renewals, which is one of the reasons why the Department of Education was trying to get you to opt into automatically pulling your adjusted gross income from the IRS data retrieval tool. Now, they haven't quite gotten that system synced up yet, so we'll have to see what happens, right? But the goal there was to try to reduce the number of people who were missing those renewals by using those income-driven repayment plans. Paying more than your income requires while you're using an income-driven plan. If your income generates a minimum monthly payment and you still feel like you can afford to pay more, look for those other areas in your overall financial wellness that we talked about to boost first, right? And if you still feel like you have extra funds to pay more, then consider your forgiveness fund, right? Is there a way to boost that, right? If you still find that you have more that you want to pay towards your student loans, well, calculate it out, right? Is that extra that you're paying going to help you reach zero before you hit forgiveness? Maybe it'll help, right? But if you're still going to end up hitting forgiveness, even though you're paying more, then you're just going to be voluntarily paying more towards your loans than you have to. And that dovetails with this one we've talked about a lot tonight, right? So make sure you're not foregoing other more critical areas of your overall financial wellness ahead of paying extra towards your student loans. Switching away from an income-driven plan or refinancing, right? And that leads me to this, other public service announcement. Don't refinance your federal student loans. Right now, we are seeing, or we will see probably, interest rates coming down, and you'll probably start to see SoFi and some of the other private lending national organizations making a push to get you to refinance your federal student loans into a new private loan, right? And this differentiates between federal consolidation, which is paying off your federal loans with another federal loan. This is paying off your federal loans. A refinance, in the context I'm using it here, is paying off your federal student loans with a private loan. Right? And those private loans do not have any of the benefits that we talked about tonight. Right? They are essentially a new traditional loan. Right? That's going to have a minimum monthly payment that you're going to have to pay regardless of your income circumstances. And they may even, coax a cosigner to the table to help give you a lower rate. Right? So they could end up putting your spouse or your parents or some other family member on the hook for your student loans if you can't make those payments. And that's never true for your federal student loans. Right? So don't exchange the most flexible debt that you'll ever have with less flexible debt, right? Just for maybe a lower interest rate, right? It's not worth it. Deferment, we talked about, triggers additional capitalization. So use those income-driven plans instead. Right. Okay, so probably have time for maybe one more here. Which one should we finish up with? And then any other questions that you guys have that or things that you thought I would cover that I haven't touched on yet or haven't covered. Married. All right. Okay, it's complicated for sure. So when you have federal student loans and use an income-driven plan, they're going to ask you if you're married. Then they're going to ask you if your spouse has student loans. Right? And how did you file your most recent tax return? So because the payments under an income-driven plan are based on your income, and because of the incentives in the tax filing code to get married and file jointly, right? If you file your taxes jointly and both of your incomes are on that joint tax return, they're essentially combined in that adjusted gross income number, then they're going to use that to calculate your monthly payment. Now, if your spouse also has student loans, like this is the case for my household, right? So we both have student loans, we both have income, we file our taxes jointly, our payment is calculated from our joint incomes, but that payment is then proportionally applied to our respective student loan balances. And so my spouse's student loan balance is higher than mine, right? It's about 60-40, right? So 60% of the calculated payment goes towards her student loans, 40% of the payment goes towards my student loans. And that's because we both have student loans and because we both filed our taxes jointly. There can be cases where if you have the student loans, your spouse doesn't have student loans, where you may benefit from filing separately, right? And in that case, you file your taxes separately. Your income is on your own tax return. Your spouse's income is on their own tax return. When you apply for an income-driven plan, they'll use only your tax return, but they'll also exclude your spouse from the family size, which will have an impact on the monthly student loan payment, right? So you can file your taxes separately if you want to exclude your spouse's income from your income-driven plan payment. It'll probably cost you more in taxes to file separately, but if you save more in monthly student loan payments, so essentially you pocket more overall by filing separately, then it makes sense to file those taxes separately. And that could change from year to year, right? You can file your taxes jointly last year, file them separately this year, and then file them, jointly again the following year, right? So you can change your tax filing status from year to year, but you're going to want to go through that exercise each year to see which combination is going to help keep the maximum amount of funds in your overall household. And that's probably one of the more complicated analyses that we do. And that actually gives me an excuse to tell you guys about the student debt message boards, which I have completely forgot about until now. So when you're on the Student Debt Center and you've uploaded your student aid data file, you're going to get a pop-up box on here that asks you to log in, right? And we only let veterinary students log in here, right? Now you don't have to be an active member of VIN to be able to log in. You just need a VIN username and password. That's one of the ways that we screen you to make sure that we're only helping veterinarians, right? You can see here that it knows that I'm logged in, right? I logged in with my VIN username and password. So when you're logged in, it'll save the student aid data files that you upload in here, but it'll also give you a link to the student debt message board area. It's going to make me log in again. And the student debt message board area is where we provide personalized consultations. And that's where, all of this information comes from. It's where all the experience that Beck and I have working with our colleagues comes from, right? And it's where you get personal answers to your questions, right? So the way the process works is that you fill out the student debt and income signal form, kind of like a lot of you did as part of this session. And whether or not you indicated at the end of that form to have your case posted to the boards anonymously will determine whether or not it ends up on here. But we anonymize those answers that you completed to the student debt and income signal form. We use that as the minimum database, if you will, of information along with your student aid data file to work through your case on the message boards, right? So your primary complaint, right? Matching up, what are you doing? How much student debt do you have? What's your income? How are you paid? What's your most recent tax filing status, right? Are you married, recently married? Maybe you filed your most recent tax return jointly. What's your adjusted gross income, right? All of those are going to play into the answers to that question, whether or not it makes sense for this particular person to use a standard 10-year plan or maybe use an income-driven plan, right? And we'll go through and reply to your signalment form post here using that information, and it gives you a place to get that answer, to continue that conversation. You can see there's quite a back and forth here. There's about 8 replies in here, right? So this, the conversation with myself, Rebecca, or both of us go back and forth in here, doing your physical exam of your student loans with you. Your colleagues get to learn from that. You get the answers that you need, right? But the overall community gets to understand student loans a little bit better, right? So that's where we answer a lot of these more complicated questions using the Student Debt Center tools and walk through some of those analyses with you. So you can review it later. You can sit down with your accountant or your spouse and review it with them. And then you can come back and post any additional questions that you might have. But we'll also use the student loan repayment simulator to help work through some of these analyses. Right? So there's going to be 2 primary components that you're going to need to compare when you're married and you're using an income-driven repayment plan. Right? So this is the student loan repayment simulator. Right? We brought over the information that we found from that student aid data file in here. We can enter their current income information, right? And in this case, I know that they had a adjusted gross income from vet school that was about $6,500, right? So the year 2024 payment was based on your prior year's tax return, the 2023 tax return that was filed in early 2024. Right? So that's why I adjusted that one. Right? But if you're in here and you're married and you want to see what the differences will be in monthly student loan payments, well, you fill out your family information. So yes, I'm married. if I file my taxes jointly and my spouse has, $60,000 income, maybe their income doesn't increase that much. Maybe they don't have student loans, right? Maybe I've got a child already, planning to have one in the future, right? The family size, that component works through the discretionary income formula, right? So I'm going to run this simulation and I'll see what the total cost is using a plan like the old version of IBR. I might even look to see what the standard 10-year plan payment is, right? So 363, 500. I'm going to come back up here, flip the switch to married filing separately. Do I live in a community property state? I'm going to leave that no, but I'll come back to that in just a second. I'm going to run that simulation again. This simulation will then exclude the spouse's income from the calculation. And you can see that we reduced that total projected repayment cost by nearly $70,000 there. Right, so $70,000 over 20 years, is that enough to justify the additional cost of filing your taxes separately? That's where the accountant can help you answer that question, right? But the simulator will help answer what are my student loan repayment cost differences filing jointly versus separately. And then the accountant can help you piece together the other component, which is how much extra in taxes might I pay by filing jointly versus separately. So that's how you can use the simulator to help answer that question as well. So I mentioned the community property tax state. So community property taxes are California, Texas, Louisiana. If you're actually in the loan sim, we've got a link up here to a Wikipedia page. These are all the community property states. Right, so when you're in a community property state, essentially, when you file your taxes separately, about half of your household income ends up on your tax return, the other half ends up on your spouse's tax return. So there can be additional opportunities or benefits available to you depending on what the breakdown of your respective incomes are if you live in a property tax state or community property tax state and you file your taxes separately. Right. So it's all really a cost benefit analysis, right? And again, we wouldn't waste your time with this if it was just a couple of $1,000s either way here. But as we saw in that one simulation, there's a potential difference of $70,000 in student loan repayment costs over time. So it's worth taking a look at, right? Those are some pretty big numbers. And if you have access to that amount of money that you can then work into your overall budget, your wealth building plan, that can make some pretty big inroads long term. All right. Cool. Any other last questions that you guys have as we wind down here? Hopefully you found this useful. I know there's still quite a bit of uncertainty. I'm not terribly worried. I mean, of course, I'd love to know what's happening versus sitting here wondering what's happening. But again, chances are we're going to have some income-driven option remaining, and they're just so beneficial that they're worth waiting around to see exactly what they look like. And thankfully, in most cases, if we're in that forbearance, it's not costing us anything to wait a little bit longer to get that uncertainty. So use that as an opportunity to look over your student loans, but also to boost those other more critical areas of your overall financial wellness.
And as Tony pointed out, I mean, use the student debt message boards as well. Ask questions of us, and kind of talk through what your options are. Unfortunately, we've seen too many people that get a little nervous and pull the trigger on something and then start asking questions, and it's like, oh, I wish we had talked this through beforehand. So definitely learn and ask questions.
Yeah, very cool. Thank you. And you guys will have access to these slides too. We'll make the presentation materials available to you, and you'll also get a link to a recording. But this presentation lives online, so you can, when you have the link to it, you can click through all of these different areas that we visited, and in some cases, some of the areas that we didn't get to, and you can look and see what's in there. And any of the areas that I have links to, those are active links that'll work for you if you click on the presentation afterwards. Cool. With that, I'll wish you all a good rest of your evening. Stay tuned for more information on student loan repayment and what's next. And, in the meantime, work on those budgets and overall financial wellness. And we look forward to helping in any way we can. All right. Good night, all.